Kia ora koutou katoa. Koe nei te takiake, te tīmatake i tā tātou hui a tātā nei i runga i te karakia. A tēnei karakia, hangaia hei whai whakaaro mā tātou ki ngā kaupapa ahuārangi. Nō reira i runga i tēnā, mauri ora ki te rangi, ko i umatua kore anake. Mauri ora ki te whenua, ko tātou tēnei e tau nei. Mauri ora ki te tai ao e tau awhi nei i a tātou. He ahunga nui te ahuārangi, he ahunga nui te ahu tangata, hui te marama, hui te ora, haumi e, hui e, tā aiki e. And without further ado, I'd like to introduce our Governor, Adrian Orr.
Tēnā koutou katoa, kia ora ana tātou katoa katoa. Welcome everyone, thank you for joining us today. And I am delighted to be here with my colleagues who have done an enormous amount of work around the document that we're here to talk to today, Climate Change 2021 and Beyond. I'll be introducing Simone Robbers, who will be talking directly with you, Toby Fines and Susan Livengood, who all three of them have been instrumental in developing our climate change response and the mahi that we are sharing with you. I want to thank also all of the staff of Te Pūtea Mātua. There's an enormous amount of work both to get where we are today, but also the commitments that we're putting on the table for us to follow through in decades to come. Also beaming in with great pleasure from Dunedin is Professor Ivan Diaz. Ivan, it's wonderful to have you here. From the University of Otago. I see you're well set up there. Ivan is going to be sharing his insights into climate finance and really the role of the finance community in addressing the issues of climate change. Just briefly, Ivan is the director of the Climate and Energy Finance Group, and it's one of the largest climate and green finance academic research teams in the world. It's great to have you here in Aotearoa, New Zealand, Ivan. He's also director of the Global Research Alliance for Sustainable Finance and Investment. In fact, he was the founding partner to both of these institutes, I believe. So it's great to have you here, and I look forward to hearing more from you very soon. As mentioned, today we are very pleased to be launching our report, Climate Change 2021. As you can see, the title is deliberate, changed, and we're saying that because the climate on planet Earth has changed already. It's not something that we are worrying about in the future, it is here and now and real. So it's deliberate, and with it has changed people's expectations, both of their own behaviours, but especially of leadership from governments around the world and industry. And for our purposes, the finance industry, banking and insurance. And so we're going to be talking a lot about the change we expect to see. First and foremost, though, the document is about our role, Te Pūtea Mātua, in addressing the risks related to climate change. We've been asked many questions. Why is the Reserve Bank, Te Pūtea Mātua, at all interested in issues of climate? Why are we concerned about climate change? What is our role in providing solutions to some of the risks arising from climate change? And how are we collaborating with experts both domestically and throughout the rest of the world to make sure our work is the most effective it can be? So this document today really is our response. It's our answers to these questions, and we are laying down both what we're doing today and our commitments ahead. I'll repeat several times, the more people that read this document, the better. That means the more people there are out there to hold us accountable to what we are saying today, just as we will be holding others accountable to their commitments around managing the climate risk. This document, really outlines our responses, and when you think about it, it's quite straightforward. At the core of the Reserve Bank mandate is always this word stability. That can mean stability in prices, monetary policy, but also stability in financial institutions and the financial system, financial stability. Monetary and financial stability are our core purposes, and climate change really challenges financial stability and economic stability. So it is directly within our area of interest and our remit. This includes both the physical impacts of climate change that we are perhaps more familiar with, droughts, floods, extreme weather patterns, but also the impacts of transitioning from a high carbon emitting economy to a low carbon emitting economy. And that transition globally will come with risks and opportunities to the financial sector. Our strategy is pretty straightforward. It's got 3 legs to it. The first one is to make sure our own house is in order, and that is to measure and manage our own carbon emission profile from here and going forward. The second part, where we are interacting far more with our regulator institutions, is to incorporate ideas of climate change risk into all of our risk identification, risk assessment, and supervision prudential management for the banking and the insurance industries. And so that is where we can play a significant role domestically around raising awareness, identifying, managing, and mitigating financial risks. And the last part, the third leg, really is our role representing Aotearoa New Zealand on the international stage, being a connected party to the global best and interested in the world of climate change. We put that down to mā tangi rua ki mā tangi rea, working together to reach our joint goal, working in unison. I want to really just finish my little opening dialogue on some positive notes, because we're all worried about the negative implications. But first and foremost, we've seen significant national progress on these issues. Is it sufficient? No. There is more to do, but let's recognise progress and setting a framework for financial disclosure. That progress is well underway, and some industries are already ahead of the curve and are already disclosing their climate-related risks and how they're managing it. We have received the Climate Change Commission's first missive and set of advice to the government, and that has created the discussion document that is now out there for government's plans. And we are very proud to have been part of and remain part of the launch of Toitu Tahua, the Centre for Sustainable Finance. So, great initiatives here in Aotearoa, New Zealand. Internationally, there are things that mirror the activities. I would say we're probably following more than leading. But here at Te Pūtea Mātua, we are a member of the network of central banks and supervisors for greening the financial system. This is a global network of around 100 central banks and other prudential regulators working on issues that are similar across countries, and also the Sustainable Insurance Forum with exactly the same kaupapa, the same drivers. And we're very pleased to see the focus being on finance at the United Nations climate change discussions coming up in coming days, known as COP26. The finance sector is not only at risk, there is massive opportunity for the finance sector, both individually, but also to lead to the change that will get us to a net zero carbon world economy by 2050. Driving these global efforts is this overriding knowledge and fact, I would say, that to get from where we are to being a low carbon economy and a climate change resilient economy, the longer you delay the necessary changes, the more abrupt those changes are going to be. So a smooth transition from here through to 2050 is an ideal transition. Doing nothing and then sprinting at the end may prove to be too late or far too abrupt for future societies. This is why we're acting today and why I'm encouraging a wide readership of our document and reflection yourself and your own industries around what you could be doing the same. We know the tools that we are talking about today are necessary but far from sufficient to achieve net zero carbon. We're talking about stress testing, we're talking about regulatory disclosures, we're talking about basically interventions that a central bank can make. They are not perfect, they are not sufficient, but they are good enough to get started and move in the right direction. So, throwing the challenge out there to get started. I would say driving all of this is the simple fact that the past is becoming a far less reliable guide to the future. With that, I want to say me taki ma'ata for listening, and I will now pass you over to Professor Ivan Diaz-Rainey.
Tēnā koutou, tēnā koutou, tēnā koutou katoa. Thank you, Governor Orr, very much for the opportunity to say a few words about climate finance at the launch of this important report. As you intimated, this report is really timely. We have COP26 in just around a week's time, and a central issue around that is going to be climate finance. So climate finance is going to be at the very heart of those discussions. Academics have become very interested in the nexus between climate change and the financial system, and it's increasingly clear that every corner of the financial system will be impacted by climate change. Every actor in the financial system will be impacted by climate change, including central banks. Climate change and its interaction with finance and financial systems poses a paradox. On the one hand, it actually represents an unprecedented opportunity, but at the same time, it poses large and potentially systemic risks to the financial system. The way we can understand climate change and its interaction with the financial system, it can be seen from the financing green, the opportunity side, and as Governor Orr intimated, the financing of wind, solar, energy efficient buildings, decarbonizing transport. So there is a strong business case. A lot of these technologies are now either cost competitive or increasingly cost competitive. There is the flip side, which is obviously also more relevant to central banks, which is greening the financial system. And this has an element of creating sustainable financial products, but it's that physical side. And as Governor Orr mentioned, that has three components: physical risk, transition risk, and liability risk. And physical risk, we all understand, it's highly intuitive. It's around droughts, flooding, wildfires, and the financial impacts that we've seen. We've seen that in California, we've seen it in Greece. Yeah, that's very clear. Transition risk is a lot more subtle, and that's around winners and losers as we decarbonize the economy. And then we also have liability risk, which can come from insurance claims related to the droughts and floods, but also litigation. We're seeing a lot more investors undertaking climate finance related litigation. If we can move to the next slide. So returning to the opportunity side, there are grounds for some optimism. This chart shows signatories to something called the Principles of Responsible Investing. And so now investors, actually the large majority of assets under management pension funds are now PRI signatories. In other words, they take ESG into consideration when they invest, so environmental, social, and governance aspects into their investment decisions. So these are assets under management, are pension funds, and they do increasingly they're increasingly trying to align their investments with environmental issues, of which obviously climate change is right at the heart of it. So there's a lot of money that wants to do good, but there is a funding gap if we move to the next slide. And this is obvious from the climate mitigation funding gap. So this is the amount of money that we need to invest to really decarbonize our economy, to reach the goals of the Paris Agreement of staying below 1.5 degrees or at least 2 degrees. And you know, in 2019, the amount invested was around 600 billion, whereas what we need to invest is really measured in the trillions, somewhere between 3.8 trillion and 1.6 trillion. So there is a large mitigation gap to reduce those greenhouse gases. And this has a knock-on effect on the risk side. So if we move on to the next slide, is that if we do not mitigate, it means that ultimately future generations are going to pay a price. And this gentleman, Mark Carney, who was governor of the Bank of Canada and also of the Bank of England, came up with this term called the tragedy of the horizons. And this is to highlight the fact that if we do not mitigate now and mitigate fast, future generations are going to face the losses, and the cost of adapting. So this is a real issue. There's an intergenerational issue that we really must keep in mind. The other thing to say here is that, as Governor Orr mentioned, the impact of climate change is not just some distant risk. It's happening now. We see it around the world. And so there is this need to mitigate, and we need to scale up mitigation. We need both mitigation and adaptation finance. So adaptation finance is learning to live with the effects of climate change. But if we don't mitigate, those effects will get worse and worse. So we need both, but there is ultimately a trade-off. If we don't do enough mitigation financing, we're going to have a lot more risks to the financial system and a lot greater needs in the far future to have greater quantities of adaptation finance, which will be harder to do, costlier, and will require more state intervention. So if you like a small state, embrace the mitigation opportunity that is presenting itself currently. Next slide, please. So hopefully you're getting a sense that most actors and most corners of the financial system are being impacted by climate change and will increasingly do so. In this context, I really welcome this report. It's a very important step. It embraces several trends domestically. We've seen various initiatives to green the financial system and green finance, not least by the Aotearoa Circle Sustainable Finance Forum. And as intimated by Governor Orr, we also are going to have mandatory financial climate change risk reporting for our large institutions. Also, there is this big move for central banks to better understand their risks, and RBNZ is one of 95 members of the Network for Greening the Financial System, which has grown incredibly over the last 2 years. So there's incredible momentum around this. Central banks face real challenges around this, around their own operations. So, their own greenhouse gas emissions, those are relatively small. But, in terms of their balance sheet, so central banks obviously hold bonds, and those bonds may have some climate risk within them. In terms of prudential regulation, the obvious risks there, initially, at least in New Zealand, would be around insurance companies who are facing these liability losses around physical risks. But more generally, how it plays out globally and systemically, there are systemic considerations as well. There are considerations of monetary policy as well. So loose monetary policy has been argued to benefit legacy, carbon-intensive sectors. So, there are real challenges for central banks, and it's a challenge for them because they need to develop new capabilities, new skills. They need to start looking forward rather than just looking at the past in terms of and engaging with climate scientists. So it poses unique challenges. And in that context, it's really great to see the Reserve Bank present this report and do the hard yards that was involved in putting together this report. So I welcome it very much. And I commend the Reserve Bank for doing so. And I thank you for the opportunity again to help say a few words, and I pass on to Assistant Governor Roberts. Kia ora.
Thank you, Ivan, for your support and for those insights into climate finance internationally and the fast pace in which central banks and the broader finance community is moving in relation to climate change. Tēnā koutou katoa, ko Simone Roberts tōku ingoa. It's my pleasure to be here today to take you through some of the key points of our report, Climate Change 2021 and Beyond. Thank you for your time today, and thank you for your interest in our work on this critically important and complex issue that is climate change. This afternoon, I will highlight some key points from the report, and afterwards there will be some time for media questions. As Governor Orr alluded to, you may be wondering about the title of our report. It's not a typo. The words climate change highlights the misconception that climate change is a problem for the future or an emerging risk. In fact, as the Intergovernmental Panel on Climate Change highlighted recently, climate change is already widespread in terms of the physical impacts such as floods, drought, sea level rise, and temperature rise. And the title also refers to another change that has already begun to happen. This refers to a change in the financial, legal, economic, and policy climate brought about by the challenge of responding to climate change. It underscores the fact that business as usual no longer exists. We operate in a world of different risks, and the challenge of understanding and managing these climate-related risks is already here. Next slide, please. As Adrian and Ivan have both highlighted, climate change is core to our mandate, and a key concern for us is the exposure of the financial sector, including banks and insurers, to climate-related risks. We adopted our climate change strategy in 2018 and joined the Central Banks and Supervisors Network for Greening the Financial System and the Sustainable Insurance Forum around the same time. We are now one of 95 members of the NGFS, which gives you an idea of the significant momentum and weight with which central banks are considering climate change globally. Here in New Zealand, climate change is also a potential risk to financial stability. New Zealand faces challenges from physical risks such as droughts, floods, temperature rise, and sea level rise. New Zealand also faces challenges from the transition to a low carbon economy. These transition risks could mean significant shifts in asset values or stranded assets or higher costs of doing business. It's important to note that these physical and transition risks can intertwine, can intensify, and can snowball. For example, it's plausible that agriculture could face a drought, a consumer shift towards plant-based protein, intensified regulation, and carbon border adjustment mechanisms all at the same time. The transmission of climate risk to the financial system needs to be better understood, and it is difficult to measure. We take climate change seriously, and our focus is intensifying. Next slide, please. So our report today sets out our approach to climate change, our progress, and our future direction. Here at the Reserve Bank Te Pūtea Mātua, our climate change strategy has three components: getting our own house in order, so managing and monitoring our own climate impacts, getting the settings in place, so mainstreaming climate by understanding and incorporating the impacts of climate change across our core functions, and showing the way, leading through collaboration. We want to be transparent. We have made progress, but we have a long way to go. Next slide, please. So the first component of our climate change strategy is getting our house in order by monitoring and managing our own climate impacts. So this chart shows our operational carbon footprint. We calculate our footprint and have it independently verified using the Greenhouse Gas Protocol. We're constantly working to improve the scope and data quality. You'll see from the chart that last year we increased our scope to include purchased goods and services, and we sought to develop a stronger baseline for our emissions. A robust carbon footprint is the basis for credible reduction targets and a reduction pathway, and our future plans involve setting and implementing an emissions reduction pathway. Next slide, please. Staying with that first component of our strategy, we use our balance sheet to achieve our monetary policy and financial stability objectives. So we made a notable contribution to our sustainability goals in 2019 when we purchased US $100 million of the Bank for International Settlements Green Bond Investment Pool. This investment was small when compared to our total government bond holdings, but we saw an opportunity to begin our journey with confidence alongside a number of our central banking peers. This year we have engaged Trucost, a division of Standard & Poor's Global Market Intelligence and a specialist in measuring the CO2 emissions of financial portfolios, to provide an independent estimate of the carbon intensity of our government bond holdings. This chart shows Trucost's analysis using a weighted average carbon intensity metric. Our next steps here are to assess carbon-related portfolio risks and consider how we can incorporate sustainability objectives into our balance sheet while maintaining our ability to effectively execute on our policy objectives. Next slide, please. The second component of our climate change strategy is to get our settings in place. In other words, mainstream climate by understanding and incorporating the impacts of climate change across our core functions here at the bank. We actively work to inform government policy on climate change and areas relevant to our remit. We work with lead agencies working on the planned climate-related disclosures regime, including MB, MFE, the XRB and the FMA. While other agencies are in the lead on the design and implementation of the disclosure obligations, the matters that disclosure cover will fall mostly within our areas of concern as a prudential supervisor. As such, we're beginning to develop our own guidance on climate change risk management for our regulated entities. The guidance will not impose new requirements in relation to climate risks. Rather, it will support compliance with our existing risk management and governance requirements and will provide guidance to assist entities to manage their climate risks. Our approach will follow that of other regulators, for instance, the Australian Prudential Regulatory Authority, APRA and Monetary Authority of Singapore, and it will focus on physical, transition and liability risks. Turning now to financial system analysis. Next slide, please. Our biannual financial stability reports have highlighted potential impacts of climate change. In this report, we highlight a 4-step process towards a scenario-based climate stress test. The first step came this year when we marked the launch of an annual stress test cycle for banks and our first insurance industry stress test. As part of this, we've added climate-related events to our stress tests. We will report on this in an upcoming bulletin article. The second step will assess particular exposures important for financial stability in New Zealand. The third step is to review international literature, learn from other regulators, and deepen our analysis of how we could use the NGFS scenarios here in New Zealand. Finally, the fourth step is to work in consultation with industry to design scenarios. Next slide, please. Touching now on supervision, we've incorporated climate change into our scheduled supervisory engagements with the management and boards of regulated entities to assess governance, strategy and risk management frameworks. We aim to further embed climate risk into our supervisory frameworks, our data collection and our internal training. Next slide, please. On monetary policy, we refer to the ways that climate change affects our economy as transition mechanisms. For example, as the economy adjusts to the changing carbon price and other factors, there will be changes in resource allocation, new investment in some sectors, and withdrawal of capital from others. These will affect the economy's growth rate and inflation dynamics. Presently, our economics department is analysing the latest set of climate change scenarios from the NGFS to assess how our approach to monetary policy should account for the impacts of climate change. Next slide, please. Turning now to the third and very important part of our climate change strategy. Our approach to climate change recognises the imperative of collaboration. We stress the need for a coordinated and aligned approach. In the context of climate change, leadership means having the courage to face complexity and work through it together. We need to learn quickly from each other to share best practice in understanding and managing climate-related risks. Internationally, we collaborate with groups mentioned such as the NGFS and the Sustainable Insurance Forum. Here in New Zealand, we collaborate widely, including with scientists and industry. We also lead the Council of Financial Regulators Climate Community of Practice, and I'm proud to be involved with Toitu Tahua, the Centre for Sustainable Finance. Last slide, please. Finally, I need to emphasise that we, along with other financial regulators and the institutions we regulate, are only at the beginning of our work to understand and incorporate climate-related risks. Climate change holds key risks for the financial sector and will require further and deeper understanding of how the financial risks of climate will play out in the longer term. We stand ready to play our part and we're not waiting. Thank you, and we're now ready to take your questions. Kia ora.
Well done. Thank you very much, Simone. And I am here with a very wise panel of folk and willing to receive questions.
Thank you, Adrian, Simone, and Ivan. Our first question is from Mitchell Alexander, TV3. Kia ora, Mitchell here. Thank you very much for that. This question is to you, Governor. How significant of a risk does climate change pose to New Zealand's, I guess, financial stability? And what would your message be to entities across the country in relation to responding to this?
Thank you. Great question. I would say it poses the most significant risk that has ever confronted the financial system, both here and internationally. It's a risk that has been so slow moving that there is a real danger of not reacting in sufficient time. So now we are saying, let's get ready, let's use every single aspect of what we can do as a regulator, what companies can do, what consumers and investors can do, and what governments can do with regard to leadership to work together to make sure the transition happens to the known climate change that's going to occur. At present, we are aiming for globally to cap the increase in temperature at 1.5 degrees above pre-industrial levels. We are well away from achieving that. So significant additional effort needs to be made. And in doing that, the financial sector can either be can react to it in a negative way or be proactive, where we are pricing and providing a premium for investing in sustainable activities, and likewise a discount for investing in areas that are just not going to be sustainable. So it is a massive risk. New Zealand stands to be exposed in its own unique way, not necessarily more than other countries, but certainly by as much as other countries. Our distance becomes a problem. Our agricultural base is always a challenge. Consumer preferences around eating things closer to home, the whole change in what protein development is. There are so many different aspects that can impact the economic viability of our current activity. You know, the cry out now is to start thinking hard about the transition activities.
Cool. And could I just quickly ask one more quick question? How important is it to get that transition right? I know you've already sort of touched on it, but how important is it to get that transition right to a low carbon economy?
I would say it's incredibly important. The longer it's delayed, there's some great slides in the document there. Susan, you might just want to chat briefly to the cost of delaying in terms of temperatures and.
Yes, thank you, Governor. So in the report, we've got a great slide on page 29, which really looks at average carbon pricing under two different NGFS scenarios. And what that really shows is that if there's a delay until 2030 in terms of significant mitigation, then the risks to financial stability will go up, because there's much more chance of an abrupt transition, which is much harder for businesses to deal with.
In short, you would go from, say, just taking carbon pricing, they're talking, you know, the scenarios here internationally, US $200 per unit, going up to, you know, a multiple of that simply by delaying the transition till 2030. So very quickly it becomes non-linear in terms of cost, and that means pace of activity change. And it would be near impossible to evolve so quickly to relative prices. A lot of businesses would come to a halt. So start now and think how you profit and benefit for the long term, rather than assuming it will go away.
Our next question is from Anand Zaki, Radio New Zealand. You're just on mute there, sorry. Anand.
Thank you for that. Look, just on transition again, you know, you mentioned that the climate has changed and that action, you know, needs to happen, you know, the sooner the better. But how do you, and I know it's early days in your plan and your thinking, but how do you address those transition risks from a New Zealand perspective?
So I think the very first thing to accept is that we are just a recipient of a large part of what's going to happen with global climate change. That doesn't mean that we don't have to get our own house in order to become a climate resilient economy. We have to do that, otherwise we will not have an economy. So there is an enormous amount of work for ourselves around that. But in large part, we need to be able to manage and become resilient. Think about the future products people would want, think about the relative prices that will happen and how we are operating today. We are going to need to sell ourselves to our global consumers, and that means significantly changing the inputs and the ways in which we do business at present. Toby, have you got?
Yeah, I mean, I think it's also equally important for the banks and insurers whom we regulate to take this into account. I mean, we have set them on the path. We've given them some stress tests. So the XRB have got this disclosure framework now. It's really up to them to pick up the baton and to make sure that they can manage this transition risk, to make sure that their clients are prepared and that they migrate their client base from the old brown economy to the new green economy, essentially what we're saying.
And all of our work is directed at that through disclosure, through provision of stress testing, through asking the questions in a transparent framework to assist people to think their way through it. And the financial system, that is fantastic at relative prices, assessing risk. That is their day job. So the more you can identify the risk and ask them to price it, the quicker economic activity changes, the incentives change.
Our next question is from Brian Fallow, New Zealand Herald.
Hi, can you hear me?
Yes, we can hear you.
It's a question, it's slightly in getting into the weeds, so perhaps best for Professor Diaz Rainey, if he's there. One of the risks the document mentions, and I think Simone mentioned as well, to the agriculture sector is carbon border adjustments or carbon tariffs. The principle is, I think, part of the EU's approach to its Green New Deal. It's also was part of Biden's climate policy going into the election. It's being mentioned as having come to the fore more given his problems with Senator Manchin. Given that, and given the push led by the EU and the US for a methane target of 30% cut by 2030, when our statutory target is only 10% cut, is there a risk that New Zealand could find itself on the wrong side of a carbon tariff directed at our agricultural exports, given that agricultural protectionism is not a new problem for us? Do you have any views of the likelihood of that?
Thank you for your question. It's a great question, and the simple answer is yes. There's real risk of this, and I think Governor Orr was sort of hinting at that. And yeah, there's increasing talk around the globe about carbon border adjustments, and that's coming from pressure from households, from individuals. That they don't want to be consuming products that have high carbon intensity. So the simple answer, yes, it's a real risk, right? And that has flow-on effects to the financial system. I know a large proportion of our debt, agricultural debt, is related to very intensive farming. So yeah, those are very serious risks.
We have Bernard Hickey, the Kaka Media.
Thank you. A question for the Governor around the potential inflation shocks from climate change policies. And some have argued that the surge in energy prices we've seen in the last 6 to 12 months is in part a result of that. How would the bank view an inflation shock that came from a response to reduce carbon emissions by increasing the cost of energy? Would it look through the shock, or how would it see it?
Excellent question. I also want to congratulate Brian. He mentioned about getting into the weeds, but the example, Brian, that you brought up there around tax imposts on our activity is real. and in fact was brought up as one of the risks to our recent free trade agreement with the UK. So it's very fresh in people's minds. On monetary policy, I think there is going to be decades of relative price transitions, and it's going to be in part because of regulatory behaviour, but mostly because of climate change itself. You know, with farming becoming increasingly difficult in traditional areas, some traditional crops being unable to be grown in places where they're established now, carbon pricing reaching those multiples that we talked about if we don't undertake certain activity. These are relative price shocks that can persist for a long time. Already we note impatience, even just over the last 12 months, of the current price shocks, in part because of COVID supply chain reactions. We've all talked about them. We all knew they were coming. We all said they may be temporary. Now, you know, the general discussion is, wow, these are persistent. And the school continues to be out around some central banks wanting to react, others not. So imagine that continuing now for the next 20 plus years. That is the world that we will be living in. It will mean that we have to, when we review our monetary policy mandate, we'll have to be really explicit on how we can manage some of these transitions. What does it also mean for the productive capacity of the economy and maximum sustainable employment? We will have to look through some very obvious price shocks, but to the extent that they are persistent and truly changing the price of the basket of goods and services we consume, then there will be monetary policy reactions. So there's not going to be any one resolution, in part around the mandate, in part around the ability to identify one-off temporary versus more sustainable versus generalised inflation. And it's that latter part that we are most concerned with, and some of the price pressures we will see will lead to quite sustained higher generalised prices. We're already seeing that in food prices globally and energy prices, transport at present.
Our next question is from Matthew Brockett, Bloomberg.
Thank you. I wanted to ask a question about your balance sheet. The report mentions that you're examining the climate-related risk on your balance sheet, and it notes that you have, for example, bond holdings in other countries, for example, Australia, which hasn't, is not has got a relatively high carbon footprint, or whatever the words that you use are. But I'm just wondering, are you saying that you're going to, reduce your exposure to those sorts of government bonds in the future, or how are you going to manage that risk?
Yeah, it's a great question. For a central bank, we have a balance sheet for a very specific purpose. One is the implementation of monetary policy, the liquidity management of the banking sector, and also to be standing here as a sense of lender of last resort when most needed, or intervening in the foreign exchange market. So very specific reasons, which mean our balance sheet has to carry a certain amount of credit stability and the ability to liquidate it very quickly. Hence, we're always invested in very high credit international government bonds. Our carbon footprint of our balance sheet is above just a simple benchmark of a G7 weighted bond holding. When you look at our bond holdings in our balance sheet, our carbon footprint is higher. And that is in part because, as you mentioned, Matthew, we have more Australian and more Canadian bonds than, say, that G7 holding. So, yes, we will have to think hard around, can we achieve the same effectiveness with a lower footprint? And by effectiveness, can we get the same level of liquidity, same level of credit assurance as we can? Now, another reason why we hold the weight slightly different to the G7 is because we also get increased revenue, increased yield relative to, say, the Japanese bonds or the US bonds by holding Canadian and Australian. So, the choices that we have to be thinking about is the revenue, the near-term revenue we might have to give up to get the carbon footprint we can for the same level of effectiveness of the balance sheet. So that is exactly the choice that is facing so many investors globally now. I do note that some central banks, I think it was the Riksbank in Sweden, they themselves chose to rule out some bond issuances for Australian territories recently, exactly for these reasons. So this is the way, these are the issues in that simple world we're being confronted with. On a more exciting level, we would like to be proactive. One reason that we hold bonds is that we take absorb bonds and provide cash back for liquidity reasons in the banking sector, and there's nothing stopping us from receiving green bonds, and there's nothing stopping institutions from issuing more green bonds that we could receive. So it's about how can we get the proposition, the value proposition going, where that becomes a far richer market for us to be able to do our business and have the win-win situation.
We have Chris Rich from Kanga News. Chris, your question, please.
Thanks, Anne. The report mentions, and I think the Assistant Governor mentioned it as well in her speech, that using network for greening the financial system scenarios for stress testing, and I think the report says it aims to do this in a way that's consistent with the scenarios used in the mandatory reporting regime. So my question is, why not use the same scenarios developed in the regime? And is there a risk of overburdening entities with two sets of scenarios?
So I'll pass over to Simon or Toby. Do you want to take that, Toby?
Yeah, I mean, simple answer is that we are working in lockstep with the XRB to develop a parallel disclosure regime, and we are making sure that our reporting requirements, stress testing requirements, etc., are entirely consistent with theirs. Should just add that at the moment their regime does not rely on any specific scenarios. So the disclosure that the large entities, banks, insurance companies and so on are going to have to make under the new disclosure regime don't actually have any specific scenarios. It's all about risk governance. But we will be developing our own scenarios over the next year or two off the back of the network for the green financial system ones, and we will be in close dialogue with the XRB to make sure that they understand what they're doing, and to the extent that they develop their own disclosure requirements, it's consistent with that.
I think perhaps what you're alluding to there is some New Zealand-centric aspects to those scenarios. So we do need to make sure that whatever scenarios we're building from globally do take account of our New Zealand environment.
Our next question is from Gareth Vaughan, interest.co.nz.
Yeah, hi there. Just firstly, I've got two actually, if that's okay. Just following on the one about inflation. I'm just wondering if the shift to a net zero carbon economy is going to be quite inflationary, whether you might have some new approaches to tackle that inflation up your sleeve, and whether there's anything you can say about that. And just secondly, on the financial stability side, if you've got, I guess, individual entities that have particularly large loan exposure to high carbon emitters, are there any particular steps you might take to encourage them to shift away from that, and what might those be?
Yeah, thank you. Around the tool set for monetary policy, no, we don't. Monetary policy remains what it is, always and everywhere money. So we will be, focusing on that. The real challenge is, what does it mean, not for relative price changes, which are a really important part of the solution, not the problem. If high carbon intensive energies become relatively more expensive and low emission ones become relatively cheaper, that is a solution. And those relative price shifts are what we want to see. It's if and when they are being, one relative price gets aggregated into generalised price inflation. That's when we have the issues, and that's when monetary policy, the demand side of the economy, that we would need to be taking action. So relative versus aggregate prices is the key for us around monetary policy. The second part?
Are you able just to repeat the second part of the question?
I quite get it.
Yeah, sure. Yeah, that was just on the financial stability side. If you've got individual entities, say for example, with big loan exposure to high carbon emitters, what encouragement or perhaps, I don't know, regulations might you have to encourage them to shift away from that?
Yeah, so transparency, it's sunlight is part of the cause and some of the solution to this climate change challenge we have. And the transparency around disclosure as to where your risks are, where are they concentrated, how you manage them, what are you going to do about it, is very, very powerful, because that will determine whether investors or consumers want to hang with you. And if you don't have a good story, but you have a strong concentration, then you have to accept what might happen to your business proposition. That is the number one, I would say, most powerful means by which we can influence. The other part, of course, at a broader prudential regulation, you said about just the risk weights and concentration, Toby?
Yeah. So as I think you know, Gareth, we set risk weights, which essentially requires banks to allocate a certain amount of capital to their loans, and the higher the risk of the loan, the more capital they have to allocate. Now, over time, we would expect that those sorts of industries that you're talking about, so high concentration to high carbon industries, will become more risky. Now, the international standards are not there yet in having any higher risk weights for that sort of concentration, but the Basel standard setters are working on it, and we will be a fast follower. But having said that, our big four banks have a responsibility to work out their own riskiness of their own loans. So we would really put the onus on them. If they see a particular risk in a high carbon intensive industry at the moment, a high transition risk, then they should be attaching high capital to that. And that's the mechanism, and we would be encouraging them to do that.
I think just to finish on that, transparency is a double-edged thing. Not only does it better incentivise appropriate risk management, it also enables consumers and regulators to see whether the institutions are behaving, responsibly. That's not just about managing their climate exposure, but also around their pricing regimes. And this is going to be a challenge for insurance and banking. Show us how you've priced these risks, because otherwise it provides too much of an umbrella to explain all future cost changes. So be transparent, show us how you're managing those risks. Time for one more?
We have time for, yes, just one more question from Bernard Hickey, the Kaka.
Thank you. Governor, on the prudential regulation side, and it was touched on earlier, but is it possible the bank could look to have specific New Zealand style risk weightings to take account of things like high concentrations of coastal property or high concentrations of dairy debt, or things like whether a bank is lending to fringe large houses that are potentially exposed in the future to climate costs from transport and are naturally more carbon intensive.
So our strong starting desire is that these risk weights are based on international standards. The more we go off-piste ourselves, the more expensive it is to doing business in Aotearoa, New Zealand. And it's not just cost, the more risk there is that single decision makers don't get it right in their own countries. So we are, I know that at the Bank of International Settlements, the BIS, the decision-making committees, they are thinking very hard around whether they do need to or not impose specific risk weightings for climate change type risks. I think over the next 12 to 18 months, we will hear what they have opined on. Is that correct? We're not holding out huge hope that that will be a significant change. We're holding out far more hope that the transparency and the disclosure will create the change that's needed. People will be more reluctant to lend to types of activities that may be unsustainable through the various risks that are posed in that activity. And to do that, that's transparency and making sure that the financial institutions are doing it consciously. They are awake. They have identified, priced and allocated the risks accordingly to those who can manage them. So simple blind lending will lead to costs. And the transitions, by the way, it will be significant. So there will be great opportunities for finance, for the finance industry to reap great rewards for assisting in the transition, rather than just accept losses by being asleep at the wheel. I think we can leave it there. I just want to very briefly thank all of the colleagues at Tipu Te Mātua for their good work, and all of the collaboration and assistance we've received from the many parties. And I want to thank Ivan. Thank you for staying close. Keep us honest and informed. And thank you everyone for beaming in today. Do read the report. Mai taki mātai.